From the morning reading, indices reverse Wednesday's gains, short-term defensive. All 10 sectors moved lower on Thursday. XLE, XLY, and XLK were the strongest sectors, while XLV was again the weakest sector. Oil futures rose 56 cents to close at 47.72. Breadth weakened compared to the prior session as decliners led 24.21 to 645 on the New York Stock Exchange and led 21.49 to 688 on the Nasdaq. In other reading, the S&P 500 snapshot a sell-off on Deutsche Bank angst. This morning, as we ended a 2-week stay in Germany, the newspapers from Britain grabbed at the Berlin airport were primarily focused on the Deutsche Bank as the potential trigger for the global financial crisis. The S&P 500 paid relatively little attention to the upward revision of Q2 GDP from 1.3 to 1.4%, or the better than forecast jobless claims. Rather, weakness in financials took center stage. The index churned in the shallow red during the morning and then plunged during the early afternoon to its minus 1.21% intraday low. A bit of afternoon buying trimmed the closing loss to 0.93%. The yield on the 10-year note closed at 1.56%, down 1 basis point from the previous close. In other morning reading, fund managers have thumbed their nose at cash. According to the latest release from a leading industry association, mutual funds are holding only 3% of their assets in cash. Given the level of interest rates, they should be holding less cash than usual, but not this much less. According to our estimate, they should be holding about 1.5% more of their assets in cash, the largest difference since 2007. Investors are holding more than $4 in stocks for every $1 in cash. According to the same association, investors are holding 4 times the amount of mutual funds and ETFs than cash. That's actually down from the peak in 2015, despite record highs in stocks, setting up a curious divergence last seen in 2007. Crude oil enjoyed another day with a large gain. For the 5th time in 7 sessions, crude jumped more than 1.5% on the day. That kind of buying cluster has been rare over the past 30 years, though it has happened a handful of times since 2015. Crude struggled in short term after the others, but had a tendency to continue to rally over the medium term. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:30 a.m. Mountain Time, and I'm recording this in preparation for the market day of September the 30th, 2016. Full disclaimers at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were just below scratch. Nothing of significant moving in those 4 indices. Crude oil also down about, just below scratch, almost 0.25%. Euros down about 0.5%. Bonds are up just above scratch, and gold also just above scratch. China just above scratch. Hong Kong, though, more significant movement, down nearly 2%. Japan down about 0.5%, and Germany down about 1%, followed by the United Kingdom down about 0.8%. In terms of macroeconomic reports for the United States of note for today, we have personal spending, core price index, Chicago PMI, University of Michigan consumer sentiment are all out today, and some of those are during market open hours, so be aware of that. In terms of current sentiment, a little bit of a pop yesterday, as you would expect. Short-term VIX went up to a 14.71. Skew still benign, though. IV percentiles across all 4 still relatively low in that they're in the lower third, perhaps not as low as some of the times in the last few weeks. But the S&P is at 21, the Russell 16, the NASDAQ at 21, the Dow at a 27. You can see we had very negative action across all four indices yesterday, with the S&P, the NASDAQ, and the Dow down over 1 standard deviation, and the IWM or Russell giving up some 2 standard deviation move, and that was after a day in which it was the only one that was up 1 standard deviation. So pretty much gave everything back that it had gained in the session prior. Let's go ahead and go take a look at those charts. And you see the S&P chart here, and I'll zero in on the most recent action here. We're still chopping around in this cloud. And we've talked about with the market timing signals and so forth that we expect to see a lot of chop, and certainly that has been the definition of the action of late. You know, a fair number of high volatility days, but when it's all said and done, they're just all kind of inside this candle here from the 9th, and nothing really has been achieved one side or another other than for some play by intraday traders. Any kind of swing motion trades that are measured in days to weeks haven't achieved anything since the 9th. The Dow, the same picture. Again, we'll zero in here, but just right smack in the middle of the cloud, just as neutral as can be. NASDAQ, of course, had been more bullish. Yesterday's action was a bit bearish, but you notice it did come way up off the lows of the day. So at least on the futures contract, this was you know, something of a recovery. And then, of course, we talked about with the Russell, here, a big bearish engulfing candle. Even took in all the tails from the prior session, which was up a standard deviation. So with a 2 standard deviation move, big rejection of that. But when it's all said and done, it's still relatively bullish and more bullish than the other indices. And we've had, you know, a bit of a bull flag here. Now, the worrisome part of that is that we've now got a lower high. Remember yesterday's session, we talked about looking for, could we get up here and break this double top? Could we get through that area of resistance? Well, with the action coming out from Deutsche Bank and so forth, we basically cut that off at the knees and have gotten back down here to the prior support areas and have established a lower swing high. So not great for the bulls. Short-term pattern is definitely deteriorated in its bullish bias. And crude oil, of course, we've had a lot of volatility of late. And you see the action here, some of that news that's come out of OPEC with chatter of potentially cutting some of those production limits in November has been supportive to the price, and we've seen something of a pop and run at least for 3 sessions. Also of note before I change, note that we're up above this swing high right now. So the question is do we go all the way back up to the 49.43? That should be what's in play at this point. Gold, of course, also in a neutral stance, just chopping around inside the cloud. Nothing terribly exciting about that right now. Bonds have been moving up, and certainly with the weakness that we've seen in the indices of late, not surprising that bonds would start to gain more strength. Though this is below the cloud, and you know, certainly nowhere near as postured bullish as it was for many months here prior. So we'll have to wait and see if this develops into something, especially if we start to see some trending action across those other markets. Right now, a little bit of strength coming in the short term on long bonds. And then finally, we'll take a look at the volatility. And you see yesterday we did definitely get a bit of a pop, but you know, not too far. I mean, the high on that was about 15 3/4 and closed well down off of that, about the 14 handle. And also last night popped up a little bit and then now has been coming back down, and again down below 14, so nothing terribly worrisome here in the VIX at this point. Let's go ahead and go to the daily report. And some changes here in our market timing signals. The first one, no change. IBD provides us with the first signal. Remember, all three of these are mechanical. First one is confirmed uptrend, which is bullish. But the second one, while still on a bullish signal, still a buy signal that's been in place since 9/22. The GMI index is weakened to a 3 out of 6, and the GMI2 to a 6 out of 8, so a bit weaker there. Also a change in the third mechanical signal, the stock charts decision point scoreboard. You might recall that both of these signals here in the short term and the S&P 100 and 500 had turned bullish on the prior session. Well, with yesterday's action, they flip-flopped and reversed and are back into neutral. So again, we keep talking about the expectation of choppy markets when we have this poor stack. And indeed, we've continued to see that realized. The bias, or I should say, or consensus of the bias here for all three market timing signals, I'll still go with bullish slightly, but with the expectation of a lot of chop. It's kind of like the weatherman saying, you know, it's going to be nice temperatures, but it's going to be partly cloudy, and you might have the occasional shower kind of thing. So very much that same kind of expectation when we see these kinds of indications on our market timing signals. Position sizing opinion still holding up at 100% in both models. Intermediate term market posture, this is that partly cloudy. This is that scattered showers. These have weakened with yesterday's action, and you note that the S&P has gone to a first day weak bear. The Dow's had a strong bear. NASDAQ and Russell also weak bear with yesterday's action. So deterioration on the intermediate term time frame. Now this is up against a bullish sentiment line that's still in place. So the expectation is that this bear probably doesn't get very far, and indeed is well defined probably as being weak bear, and probably gets a little bit of a retracement before finding support and then flip-flopping again. And we get a lot of signals in this kind of market, and we're probably going to see another signal back to the bull side, perhaps as early as Monday or Tuesday. Seasonality tells us not to expect a lot from today, and we talked about that yesterday, that the last two trading sessions of this month, seasonality-wise, had not been very good, and certainly that was validated yesterday. We'll see what today brings us, but anyhow, that's kind of the expectation at this point. Hedge warning status, no change here yet. Level 0 plus, normal with some cautionary aspects. Also the three special opinions, no change from what we talked about in yesterday. Still being pretty defensive, though still allowing for, when your individual charts set up, to initiate some new positions. So just be careful though. Make sure you are truly being defensive. This is not a time to get overly aggressive. And those that lose their patience and just want to put on trades, they're probably not gaining much traction. And one way to look at that is look at all the most recent trades you put on. And if the last 6 or 8 trades are all negative in their current P&L, that should tell you something. Perhaps maybe not be too aggressive in putting on a bunch of new stuff. In terms of the specific warnings, we did have a couple new fire off yesterday. Market in decline and sharp increase warning fired off. And our distribution day count in the S&P is still quite high. Other than that, still fairly benign in this area. Trend base also fairly benign. Intermarket risk aversion indicators still in a largely risk-off stance, with 4 of the 5 risk-off. One did go from neutral to risk-on. We'll start to see if we start to see some movement in the others. In terms of sentiment, all very neutral in all 4 areas that we watch, and you see the fear and greed index also relatively neutral to slightly bearish, and you see a little bit more of a fear on this. It was neutral just the previous session at a 50. It did move a bit yesterday, but still not terribly extreme to either side. In terms of sector specific, it's back to the Christmas tree again. And again, these are the kinds of signals and changes in signals we get when the market is largely sideways, and these signals flip-flop back and forth on a fairly tightly wound set of indicator lines. Really, the only thing we want to focus on are the ones where we have some consistency. Transportation's consistently been up. Telecom has been generally holding up. Energy, of course, has been getting a lot of attention lately. Industrials have also, don't let that one slip by you. That one has been doing fairly well of late. And then, of course, technology has been one of the more consistent stories in the last several weeks. Retail has been also relatively consistently down. So look for where the most consistency is, and then perhaps look within those sectors for some opportunities to make a handful of swing trades. In terms of percent change, you see all the sectors were down yesterday, with healthcare, financials, utilities, and real estate, our new sector, performing the worst. Okay, that should be enough for today. And let's go ahead and wrap this thing up. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here for the full set of disclosures. We'll see you back here on Monday with the market preview from Falcon Global. In the meantime, manage that risk, and you should find greater consistency. Go learn something, and good trading.